Hi, Assalamualaikum. My name is Amir Zaidi bin Zainuddin and I am the first representative of this group, and we are going to talk on transfer pricing. For the introduction part, it is divided into three things, which are definitions, arm's length principles, and utilization of this transfer pricing. In textbook, transfer pricing is the determination of an exchange price for a product or service when different business units within a firm exchange it, and the product can be final product sold to outside customers or intermediate products provided to other internal units. When the transfer pricing is used, there will be an issue of mispricing. So that is the function of the arm's length principles, to avoid mispricings as well as to set the standards for transfer price. The last part in the introduction is the utilizations of transfer pricing, which transfer pricing is commonly used by companies or corporations with highest degree of vertical integration, which means that they engage in a number of different value creating activities in their value chain.
Hi, I'm Zaim. I would continue the discussion on the implementation, specifically in terms of theory and also in the real practice example. So for the theory part, in simple words, transfer pricing occurs when there is a transfer between one department or one subsidiary to another subsidiary or department within the same group of organization. For example, in my slide, ABC, which is the MNC multinational corporation, and ABC is a parent, has two subsidiaries, which are subsidiaries A and also subsidiaries B. Alright, so if there is a transfer of goods or services from subsidiary A to subsidiary B, it is what we call transfer pricing. There is a question that might arise is why this corporation wants to implement the transfer pricing. Basically, they want to do transfer pricing is because they want to maximize the profit by cutting the tax payable. So, take for example, in my slide, 28% tax rate in the UK and also 20% tax rate in the US. So, if there is a huge number of profit in subsidiary A and it is taxed under 28%, then the tax payable will be higher. So, it is much better if the profit is moved to the subsidiary B so that there will be tax on the 20%. So this is the fundamental concept why they want to make transfer pricing. Yes, it might bring disadvantage to subsidiary A and bring advantage to subsidiary B, but the main objective here is they want to increase the overall profits of the corporation. So the next one is about the transfer pricing in real practice. I want to talk about the Starbucks Coffee Company in the UK on how they are implementing transfer pricing to reduce their profit, which they are implementing these three strategies to ensure that their profit is reduced by a large number. Alright, so this is the summary of these three strategies of the Starbucks in the UK. So the first one is about the purchasing the coffee beans. For your information, the UK tax rate is 24% and the Switzerland, the tax rate is 12%. So it is much better if the profits is moved to the Switzerland instead of the UK. The tax is quite high. The next strategy is paying royalty. The UK subsidiary needs to pay royalty to their parents in the US, and the royalty is 6% on sales. And for your information, US tax rate is relatively low to the UK, so it will benefit the overall organization. Alright, the third one is the interest. Okay, for your information also, the UK subsidiary having losses for about 15 years and they are financed by debt, and the parents is the one that provide the financing to the UK. So because of the financing, the UK needs to pay interest expense to the parent, and the interest is LIBOR plus 4%, which is quite high. These three are the transfer pricing strategies that are being implemented by the Starbucks so that the overall tax payable of the corporation will be reduced. Thank you.
My name is Muhammad Fatih. Today, I will be continue on the benefits in implementation of transfer pricing. To gain advantage on the company group as a whole, transfer price benefits can be divided in terms of two, which are profitability and organizational management. In terms of profitability, MNE can earn more profit through, firstly, tax avoidance. MNEs implement transfer price by transferring its property to low tax countries to avoid tax in high tax countries that increase tax expense thus lowering the enterprise profit. They commonly develop properties in high tax jurisdictions, then transfer them to low tax ones as their business strategy of global tax saving. In addition, they also offer the lowest transfer price to the low tax countries, which cut down revenue made by the high tax countries, hence decrease tax expense and increase profit. For example, Amazon migrates their intellectual property from US, a high tax country, to Luxembourg, to low tax country, at the minimum price $255 million US. However, IRS claimed the price should be $3.5 billion. Eventually, the transfer was made at the price set by the court, $779 million. Thereby, the company lowered their US income tax below IRS requirement. The second one is cost reduction. MNEs may lower their sales cost by transferring goods and services with minimum price to high tariff countries. Therefore, the duty base of such transactions is lowered. This is supported by Trend Research on 2019, which he concluded if foreign tax rate is higher than home tax rate, then the higher tariff rate, the lower G&S transfer price usually executed. However, it is significantly that MNEs consistently update with a country's latest tariff rules to adjust their transfer price to reduce import costs, hence increase firm profit. In terms of organizational management, transfer pricing improves managers' performance by help them to, firstly, make timely decisions. One of the effects of transfer pricing is decentralization that promotes more timely decisions among managers, since they have hands-on input on decisions, especially on intra-division transactions. When managers are empowered and have the ability to negotiate transfer prices or choose a transfer price method, they tend to be more motivated since they have more control over results. Consequently, managers will be more responsive to the environmental changes, thereby lead their business to always move forward, thus be competitive. And lastly, training opportunities. Transfer pricing offers better training for managers, especially those seeking for higher level positions in the future. It prepares lower level managers with sufficient knowledge, skill, and experience, which build them to be good team players and efficient leaders. In consequence, they will have great potential to continuously grow in their role, henceforth be good ambassadors of their firm's brand and company. In addition, by authorizing lower-level managers to have more control, top managers can concentrate their attention only on high corporate matters by entrusting low corporate decisions to lower managers.
Assalamualaikum, I'm Nur Nabila. I will talk about issues on pertaining transfer pricing. So the issue number one is that it affects on developed countries. So when transfer pricing, we can shift the revenue from a higher tax rate country, that is the developed country, to a lower tax rate country. So the revenue that's supposed to be the developed country's revenue is shifted to the lower tax rate company, so the tax overall paid is reduced, but it will affect the actual revenue that suppose the country might have in order to develop the country. The next issue is a lack of comparison of companies and transactions. So because of that, some of the taxpayer have no option to take the margin and defend it. So when the tax authority query why they take that transaction price, they have to give a good reason, because there is no comparison or any data to determine the transaction price. Next, the last issue is litigation. So because of that, some company take the opportunity to evade taxation on certain countries if they don't have the proper policy and tax administration. So when that country that don't have it proper, so how do we want to have that proper litigation? So next is the drawbacks and challenges in implementing transfer pricing. So number one is law and regulation for different countries. So different countries have different requirements, maybe a lot of documentation, so we have a higher cost of compliance. Second is the double taxation. So shifting profits from to the lower tax country may lower the tax we need to pay, but resulting to that may have to have double tax from two different countries. So lastly is determining the intangible asset price. So intangible assets are mostly unique and cannot be compared to others simply because they have their own identity, they have their own specialty. So one company might know the best transaction price that they can put on an intangible asset, but because of that, some company take the advantage on determining one transaction price of intangible asset to minimize one company's cost. That's all. Thank you.
Moving on to the next part, which is Islamic perspective. It is on the price-making ethics on Islamic economics. In the economy of Islam, the use of riba, gharar, and maisir are forbidden, and it will create an unfair high income that eventually will create a problem of justice in the future of human activities. So we, as a Muslim, we must set a transfer price according to Sharia law, which is our guidance in every aspect of life, that will make the price to be not excessively high and generate a fair profit, as Sharia law requires managers to have a more moral approach to business, including price setting. And last but not least, we must also follow the Islamic philosophy and religion, which is to run a business in a transparent, honest, and ethical manner, as transfer price can be the main thing of all of this.
Assalamualaikum warahmatullahi wabarakatuh. My name is Amirul Taqiyun Latif. I will continue on the recommendations to the issue and challenge that we have faced in the transfer pricing. Okay, for the recommendation for the issue, that's the litigations from our transfer pricing. That's the adoption of transfer pricing regulations to the developing countries that encourage to adopt transfer pricing legislation or improve their effectiveness depending on whether the nation has not adopted the transfer pricing rules. Some countries had not adopted transfer pricing rules and others were at different stage of implementations, but these were ineffective due to several challenges that needs to be addressed. Establish transfer pricing sections or departments as quickly as possible in their revenue authorities and equip them with the necessary expertise and training in the line with best practice as outlined by the OECD and UN guidelines of transfer pricing. Legislation needs to be continuously reviewed for appropriateness, sufficiency, and effectiveness to avoid the litigations in the transfer pricings. Okay, the first recommendation for the first challenge in the transfer prices that we have faced, the different country have different law. So we need to create a regional transfer pricing regimes that set of functions and various relationships among national governments that has been established in response to particular issues that has risen up to outside one country's jurisdiction. In this case, they have transfer prices. The next challenge is intangible assets that we don't know the actual price. So the government needs to provide a guidelines, and ARS and governments need to implement valuation guidelines of intangible assets to confirm the sales between related parties are at open market values. Okay, next, to avoid the double taxations, the mutual agreements procedures needs to be had to ensure the efficient instrument for the resolution of international disputes and for mitigating double taxations, and a much more effective alternative to judicial review process for resolving such disputes. For our conclusions, transfer pricing have advantage for the company that have subsidiaries in other countries. Transfer pricing of goods or service with a certain price between one company to another company within the same controls. But this advantage has some issue and challenge that the company need to face in order to avoid pay the higher tax. They have some recommendations that we found to settle up these drawbacks. Thank you.